So we've talked about calculating a predetermined overhead rate or a single predetermined overhead rate. Many companies use multiple overhead rates based usually on production departments because different departments have different cost drivers. So in this example, we have a company with two production departments. One of those production departments uses machine hours, the milling department uses machine hours, but the assembly department uses direct labor hours. So we also use cost plus pricing. So what cost plus pricing is when we have a set markup percentage of our total manufacturing cost to get to our sales price for our job. So we have a lot of information here about our overhead rates. So we have the number of machine hours for each department, the number of direct labor hours for each department, total manufacturing overhead costs, and the variable manufacturing overhead for each department. So first we have to calculate the two rates that we're going to use. So we put that information into our equation. So we calculate the total estimated overhead for each department. So the milling department uses machine hours and the assembly department uses labor hours. So if you see on the previous slide, we were given labor hours and machine hours for both departments. So you need to make sure that you're using whichever information you need, even though you've been given extra information. So in the milling department's calculation, we don't care about the number of direct labor hours they use because they calculate their information based on machine hours. In the assembly department, it's the opposite. We don't care how many machine hours they use because that's not how they calculate their overhead. So we calculate the total estimated overhead cost for the year for each department. Then we divide the total amount by our cost driver amount. So in the milling department, we have total estimated overhead costs of $510,000 and total estimated machine hours of $60,000. Therefore, we get a rate from the milling department of $8.50 per machine hour. In the assembly department, our rate is $10 per direct labor hour. Next, we're going to apply cost to jobs. So we have information about job 407 here, and the information of how many machine hours and how many direct labor hours each job used, and how many direct materials and direct labor costs each department used. So we need to allocate the overhead to these jobs. The milling department overhead is assigned by machine hours. So we see that we had 90 machine hours in the milling department, and our overhead rate from step 2 was $8.50 per machine hour. So the milling department is going to add $765 of overhead. The assembly department is assigned by direct labor hours. They had 20 direct labor hours at their overhead rate of $10 per direct labor hour. So the assembly department is going to add $200 in overhead. Therefore, when we calculate the total cost of job 407, we will have the direct materials, direct labor, and overhead for each department added together for the total cost of the job. The next thing that we're going to do is look at the selling price markup for job 407. So we have a 75% markup of total cost plus pricing. Cost plus pricing uses the total cost times a percentage amount to get the amount of the markup. The amount of the markup will also equal what our gross margin is, because the sales price of this job will be $4,348.75, and the cost of goods sold amount that ends up on our income statement will be $2,485, giving us a gross margin, which is our markup, of $1,863.75. The other way we can do multiple predetermined overhead rates, other than by department, which we just looked at, is by activity. So activity-based costing is an alternative approach. It is considered the most true costing method, but it also takes time, and time costs money. So it takes a lot of time and technology to implement activity-based costing. We are going to look at activity-based costing when we look at Chapter 7. When we're looking at job order costing for our financial statements, so our job costs end up in the same place that our inventory costs end up. So once a job is finished, it would sit in our inventory and finished goods inventory until it is sold. When it is sold, it becomes a cost of goods sold. When we have overhead, we apply overhead throughout the period using our overhead rates. We also have actual overhead costs coming in through the month. So we'll have our actual salary costs when we pay payroll every month. We'll have our actual utility costs when we get the bill. And so we'll end up with a difference between what is applied and what is the actual. Overhead is a temporary account. So if you remember from Principles of Accounting 1, all temporary accounts have to be closed at the end of the period. So when we apply less overhead than we actually have in costs, this is called underapplied overhead. And when the opposite happens, when we apply more overhead than we actually spend, then it's overapplied overhead. We have to do something with that difference in our overhead account. So at the end of each period, our overhead account needs to have a zero balance. So this ends up being put in the cost of goods sold account. So we adjust the cost of goods sold account in order to close the manufacturing overhead under or over applied amount. And we're going to look at this in actuality, in examples, and then we're going to look at it more also in Chapter 3. All of a company's job cost sheets get collected in a subsidiary ledger. So if you remember from Accounting 1, the main subsidiary ledger we talked about was the accounts receivable ledger. So in the accounts receivable ledger, we would have all of our different customers with their own accounts in a separate accounts receivable ledger, but they would all add up to the total. So this is what job costs do. We have all of our individual job sheets, but the totals end up in inventory. If jobs are finished, then they're finished goods inventory. If jobs are not completed at the end of the accounting period, then they end up in our work in process inventory. And depending on what kind of industry we're in, we could have a lot of jobs uncompleted when we close out different work periods. Think about if we're in the construction industry and we close out our accounting records every month. Well, it's not going to be very often that we're going to finish very large construction projects within 1 month's time. And so those costs are going to add on and carry over from month to month. So I talked a little bit about this. This information ends up in work in process and finished goods inventory sitting on our balance sheet. When we sell items, they become the cost of that item becomes a cost of goods sold on our income statement, and the sales price becomes our sales revenue. So in service companies, we still have job order costing in service companies. We just have different products. So instead of manufacturing something where we have all of the direct materials that would be included in construction or manufacturing, we generally have direct labor. But direct labor service companies still have overhead. And occasionally they have direct materials depending on what the service is. So if you think about a doctor's office or a hospital, their direct materials are going to be if you take any medication or if you get a vaccine or something like that. Their labor is going to be their main cost, but they also have overhead. They have a building, they have utilities, they have equipment that needs to be used, and that stuff ends up in overhead. It's just part of the service cost instead of the difference between product cost and period cost. Um, so we'll actually look at some examples in class that look at service industries so you can see how they differ from manufacturing firms in the calculation of costs. And that is the end of chapter 2.